Hey guys, how are we all doing? Welcome to the London session recap for Eurodollar on Thursday, the 3rd of March 2022. I'm not going to do too much of a deep dive into the higher time frames because you guys should be pretty familiar with it now. Obviously, we finally got that sort of major 4-hour break of structure. Okay, and then we had a little bit of a pullback and a continued movement down. Sort of the main, debate at the moment is, whether this is swing structure or not, right? Because if we're just being mechanical and strict with our rules, and if you follow the 40 pip rule on the 4-hour chart on Eurodollar, then as we can see, right, this was pretty much 49 pips pullback. For me, that classifies as a swing pullback, right? If we stick to using these rules. Now, there's also a bit of confusion around how many candles that pullback needs to be. I think when I initially created the course, I had the rule that it should be more than one candle. In this instance, I would classify that as more than one candle because obviously this first candle pulls back, right? It fails to break the prior candle's low. We just zoom right in. So that's one candle. Now this candle here, it doesn't continue that movement, but I would still classify that as more than one candle in this pullback, right? Because it's 1, 2, it's not just like one candle and then we break straight away, okay? So if you use that rule in your plan, that you want it to be more than one candle for the pullback to be a swing pullback, then I would classify that as being valid, right? And then you have another one here, right? Because essentially what you want to see is the price does actually sustain a bit of a pullback, right? And then goes. Rather than it kind of just being a little pause in the market with almost one candle. However, since then, I've kind of noticed that actually there's been plenty of times where it has just been a pullback of one candle, and then we have gone down with the next candle, and I've viewed that as swing structure. It's made sense to me, it's looked right, and that's kind of what I've been consistent with. I don't necessarily like that the most. I would much prefer a more significant and sustained pullback. But I think, kind of just reflecting on it now that you guys have been asking questions, and obviously, until I guess I just know the way that I trade, and then other people ask questions, you suddenly have to really think about how black and white these rules have been. And I think recently there's probably been a few examples where it's only been one candle, say like this inside bar, right, which has been the more than 40 pips, and then the next candle would break and close below, and I have classified that as swing structure. However, there are a number of you who want to see, more than one candle, and that's absolutely fine, and that is more significant. So whatever you've been doing so far, stick with that, is what I would say. But if you're kind of just looking for exactly the way that I've been trading, I'm pretty sure there's been instances in which it's just been one candle. As long as it's more than 40 pips, then I have classified that as swing structure. Okay. What I'm not happy with, and what I am looking to actively change now, is the pip rule, what the number of pips that I am looking for on the 4-hour and M15 to judge as swing structure, because at the moment, right, with volatility changing so drastically, and I don't think it's going to go away anytime too soon. Don't necessarily think we're going to get massive hundreds of pips every day, but I think it's unlikely we're going to go back to what was working the last six to 10 months. So I'm going to adjust that. So over the next few days, I'm going to be doing a bit more testing, and then I'll try. Basically, I want to start the next week with like a firm new rule of what way I'm going to do it. That is, again, 100% mechanical. Okay, so I will update you guys with that. I have a few ideas that I want to kind of test first before I kind of share those with you, and then we'll go from there. Okay, so basically the way I've been approaching the rest of this week and the markups and analysis that I'm posting for you guys is just sticking to the rules that we've been doing. Okay, so on the 4-hour chart, this is more than a 40 pip pullback, so that for me was a swing pullback. We then had a break and closure below the low, okay, and then of course we then had another 40 pip pullback here, but this is where we had a lot of volatility yesterday during New York, where I believe, double check in a minute, that price spiked the low and then it took the high. Okay, so on the 4-hour chart, essentially we do have a chop because price then came down, took the low, and then took the high. We didn't get a bullish breaker structure because there was no candle closure below. So when you see price take the low and take the high, it basically just means we're ranging, we're choppy, we're indecisive, right? It's not good price action, it's low probability conditions, okay? But the other thing I was trying to make the point of, which potentially saw on my analysis for today before the session, was that overall, right, kind of ignoring this sort of the way we define swing structure for a minute, and using a little bit of nuance, we can see we are heavily bearish, right? Looking at the bigger swings in price. So even if like we did switch bullish here on the 4-hour chart, I probably would only be anticipating that it might just be to come up into this level here, and then we'd probably switch bearish and look for that lows, right? Because we're looking essentially at those bigger swings in price. So yeah, I appreciate that's you guys want a bit of a clearer and solid answer with what to do with structure at the moment, and that's what I'm saying. Just stick with the 40 pip rule if you want that simple mechanical approach. Some of you I know are kind of just adjusting to this period and just using a little bit more discretion and looking at the bigger swings in price. And since we've had that 4-hour break of structure here, you're basically not viewing this as a swing pullback yet, right? So you would still be seeing this is the low, this is the high up here, and you're waiting for a more significant pullback. And I think that makes the most sense, to be honest with you, if you are happy to use a little bit more nuance and discretion there, or you simply just adjusted your pip rule, okay, to be something bigger, whether that's 80 pips or whatever. Like I said, I'm going to do a bit more testing over the next few days and the weekend, and then I'll give you guys an answer before we start the next week, because this rule 40 pips, it's no longer relevant with the current environment. So let's just work with what we got, right? It took the high, it took the low. There's no real direction on the 4-hour chart. Overall, I'm still expecting the path of least resistance to be to the downside. Also, another thing that adds to the bearish case is this low here did not mitigate anything significant on the 4-hour chart, right? Because if I mark these lows and then I go and investigate to the left and see what we're reacting from on the 4-hour chart, there's nothing here, right? There is no demand. So for me, it's usually a good sign that this is just a weak low, and it's very likely price is probably going to run those lows and potentially come down into this level of demand. And then I'd be, a bit more expecting that we may get a pullback, right? Whether it's just a small reaction, we come lower, but eventually, I'm going to be more confident that we're going to see a decent pullback once we actually mitigate, some demand, which we haven't done yet. Cool. So yeah, in terms of trade ideas for today, don't really like price action whatsoever. Taking the low, taking the high until we kind of trade outside this doji, it's going to be pretty horrible within here, at least from a 4-hour perspective. If we jump down to the M15, again, this is where structure gets even worse. If we're using the pip rules we've been using, right, with 15 pips, you can see just how irrelevant that has now become. More so with this section of price action here that we had for pretty much New York yesterday, on Wednesday, okay? Because if you are super strict with the rules, let me see. So this here is swing structure. So this was more than a 15 pip pullback when we broke the low, right? Then we obviously closed above the high. Then this candle here failed to break the prior candle's high, and then we pulled back. So that movement from here to here was more than 15 pips. So that counts as a swing pullback. We then broke and closed above the high, which then means this was our swing low here. We then obviously broke and closed below that low, so then the trend changed pretty quickly, right? And then the exact same things again in here. It's very messy. Obviously, if we zoom out and we don't have to imagine, I can do it. We don't have any drawings on here. Problem is now when I draw, I think it reappears. But you can see the swings in price, and you can see that here, although it meets the rules we're using, it's not swing structure, right? It just isn't. It's not significant pullbacks. These movements are what I'd consider to be a lot more significant, right? But then when we came down, failed to close below the low. So if you're looking at the more significant swings in price, then when we moved up here around 5 p.m. GMT, we didn't actually, because this didn't close below this low here, that means that this is not the high, right? It's not confirmed until we get a break and closure below, right? So at this point, just imagine me using bigger swings here, right? That would be the swing high still, and this would still be the swing low, and then we didn't close above it. So if you're kind of, again, ignoring the pip rule and just looking at the more significant swings in price, it would be between these two orange lines. This would be the swing low on the M15, and this would be the swing high. So that's why then coming into London, you saw in my analysis, I kept to the rules we've been using, right, with the 15 pips, and that would give us to this swing high and this swing low, and we'd be bullish. But I said I didn't like it. I wasn't really reading too much into it, because if we look at the bigger swings in price, that would suggest that actually it's still bearish. But not even in that case either. It's not a strong bearish case, because just delete these lines because it's getting very messy. So even in that case, right, if you had this is your swing high and this is your swing low, we swept the high and we swept the low. So when that happens, right, what are we? We're indecisive. We're just ranging sidebound. So when that happens, what do we say? Stay out of the middle of the range. We want to stick to the extremities. Look to long from the bottom and look to short from nearer the top, right? And that's why I said in my analysis, if you stick to the strict 15 pip rule, for me, This was the, I'll just draw it on, right? So we had the pullback, 15 pip pullback. Again, right? These are the swings in price if you're doing it that way. So then when we had a break of structure here, that was then the swing high and this was the swing low. So that would bring us to a bullish swing range on the M15. But, you know, I don't view that as swing structure, these pullbacks in here, right? It clearly isn't. So in that case, if I'm just going to be using a little bit of discretion until I come up with a new rule, this for me is a significant pullback. Then we have one movement down here. Okay, this candle fails to break below, so it's not a break of structure. So then basically this is all one pullback. This fails to break above the high. So we're still trading within that low and that high. For me, it's just messy. It's not clear. So that's what I'm saying. I'm just viewing this as a sideways range now, looking to long from here, looking to short from near the top, and I'll just be a bit more nimble with my management. And the path of these resistance at the moment is still, like I said on the 4-hour chart, probably going to be to the downside. Especially until we kind of mitigate for our demand. We don't have to, of course. We could reject it from here, and it could be a great trade, and we could switch bullish, so on and so forth. But I have to base it on probabilities and what we've got. So that's kind of why I'm working at the moment to try and come up with a new rule that it makes more sense with the current market dynamics. But for now, marking up the charts to keep it simple and consistent for you guys, this would be the way, in my opinion, you would arrive to having a bullish structure, okay? But regardless, whatever way you have structure, should be able to recognize, right, with this kind of price action, struggling to break and close below these major and significant highs that we are now ranging. So in these conditions, you don't want to be trading in here really. You want to be, like I said, longing here or showing up here. Also, another way of looking at this, or something I want to make clear, if you looked at my analysis, again, I do encourage that you guys do look at my analysis. It seems some of you don't beforehand, and then post questions about why things are a certain way. If you look at my analysis, then you'll be able to see, right? So this low here, I did not have any demand marked on like this, because of the way I see this, right? Price came up, it came down, and then it tried to break the high, and it failed to do so, right? So that for me is a weak low. Yes, it did break this high, so that is somewhat significant. That is essentially an internal break of structure, but even then, in the stricter sense, it isn't, because that is also the internal high and low. So it's just getting very messy. But this is more when I can see this big volatile wicks like this, price is coming down, it's coming up, it's like failing to do so, it's coming into London. I have zero confidence that this low is going to hold. Zero. It's just it might do, fine, whatever. But if that's going to happen, then I would want to see price start to break up, cause supply to fail, and then we can do something like that and essentially play a confirmation entry from this level. But as it's kind of had this big volatility, it's getting horrible, it's getting messy. Prices try to come up and it's coming all the way back down. That for me is just inducement for the extreme below here. And like I said, even this, I'm not a big fan of trading from the extreme, purely because I just don't really have confidence in the way the structure is mapped. So I'd much prefer to view the bigger swings in price with the way things stand, and I'm viewing that as potentially a weak low. With all of that said, if price came into here and gave me a clean M1 entry model, then yeah, it's likely I would consider taking it. But obviously, since sort of Asia and London open, clearly the order flow has been bearish, right? A lot of momentum to the downside, sideways price action towards the tail end of Asia coming into London, and then we were starting to sell off again, right? So safest thing to do, especially when I'm not that confident in this low anyway, would be to wait for price to come into here and then give an M15 shock. But you do not have to do that, right? Keep things simple. It's an extreme zone that's swept liquidity. It has nice structural inducement, etc., etc. I think that can be personally worth the risk. But yeah, this is not good price action. This is really shitty price action. It's indecisive, right? If you zoom out a little bit and just look at this compared to right, we're starting to get a bit unclear here. But if we came into this low, I'll be more than happy to look for a potential entry within here. We have started to move away, and there was, I think, an M1 flip clean entry, which we'll take a look at in a sec. But especially with the kind of current market conditions, I'm going to wait for that refined pivot to be hit, especially as it's a reasonably big zone anyway. And if it goes, it's pretty likely this is probably going to reject something in here anyway, and potentially sell off. And if it doesn't, fine, we'll wait for the chalk, which at the moment would be up here. Strong, cool. Why is that the chalk level? Well, again, I know this confuses some people, right? But when we have this range here, this would be the actual true internal range, because that's the internal low, that's the internal high, right? Because all of these candles broke the prior candle's low. So all of this is just trading in between the internal high and low. But remember, when it's pro trend and you have a pullback, what can you do? You can basically look at that internal boss of the internal structure, right? Because how else are you going to know when potentially this pullback is over and potentially now it's ready to go? That's how you can view this. I've spoken about this in many videos. I don't want to kind of go over it too much, but hopefully that makes sense as to why. So yeah, so if we don't touch into here, and then we were to get a break of structure here, then potentially that would be a much better signal. But yeah, ultimately I would prefer to enter from within here. So yeah, hopefully I haven't confused you guys too much. I mean, this isn't the easiest, like I said, it's not the cleanest price action. I'm going to be looking over the next day or two to come up with a new mechanical rule that makes a lot more sense. So until then, what I would say to you is you've got 3 options. One, you just stick with what we've been doing, the 15 pip rule, just for another few days and just be super strict with it. And that's how you should have your structure if you're doing that. And just continue to follow that. Second option would be to introduce a new pip rule. So you do a bigger size, right? So you want to do 40 pips on the M15 and you want to do 80 pips on the 4-hour chart. You can quickly just sense check it, just test it on the last week or so worth of price action, just see if that kind of cleans it up a little bit. I know we don't have a lot of data to work with since it's got volatile, but yeah, or you can just use a little bit of discretion and kind of just what to you looks like the significant swings in price action, right? Because that's how I came up with the 15 and 40 pip rule. Is it's not just some scientific number necessarily. It's more just map on what to me looks like significant structure to my naked eye on a decent recent sample size of data, then look at what the minimum size was out of all the ones I drew on. It was roughly around 15 pips. That rule now makes sense. And remember the caveat I've been saying the whole time, and the drawback to that rule is if volatility changes significantly, then that's going to have to change, right? Otherwise it's going to become irrelevant. This for me is a perfect example of why it's not relevant. Here, arguably that still could be swing structure, right? And that's, it's still a decent breaker structure here, and that's fine. But then you would be looking at something like this, right? And really, I don't want to be getting involved like that. For me, is just not swing structure. When we can actually be a bit smart about it and put our 15 pip rule to the sideways. But anyway, I'm rambling on about this now. Give me a couple of days to do a bit of testing. I would encourage you to do it yourself, right? And then I'll give you a clearer answer as we head into next week for what I'm going to be using going forward. But yeah, in terms of the actual sort of trades for London, for the majority of it, price was just around here in the middle of the range. Not somewhere, like I said, I'm going to want to look to trade. At most, I was going to look to short from here. All right, this is a POI I had drawn in my analysis for the short, and I'm also happy to look from the long from this level here and kind of really just staying out of this. And I did not view that as a valid demand in which I would want to get long from, right? Because it just failed to do anything. The prices come straight back down to it. And then even obviously it reacted from it during Asia, and then just nothing happened, right? It's just moving sideways. That's not a good sign that this is a demand really you want to be trading from, or at least wait for something significant to happen. So I know some of you guys are looking at the wick, right? Let price come in on the M15 and then start to shoot up, cause M15 supply to fail, give you that M15 sort of internal change of character, and then you can look for something. This is just not a level of demand that you'd be looking at, and I think a big part of that as well is this sort of price action, right? Big volatile messy price action. It's tried to go up, it's coming back down. When you see this in the future, stay away from that. It's not something you really want to be buying against. This is a really, really rubbish POI. I can't really say it any more bluntly than that, to be honest with you. So yeah, so there were a few M1 sells within here, but following kind of the bearish order flow of London, which I did look at, I did mark up at, but again, not something I really want to risk my capital on, considering how all of the PA looks at. But we'll take a quick look at that to kind of show what I was meaning. So essentially, this was the range, right? Just waiting for price to break out of that. It came up to the extremity of the range, sold off aggressively, had a reaction from this demand. So at this point, I'm just thinking, okay, price is literally just ranging, right? The kind of the lows are holding, the highs are holding up here. But then what happened? Well, it had this reaction, came back down, chopping around again, so they're not really paying attention, and then boom, right, that bearish order flow comes in. So if you're looking at sort of European volume kicking in, right, what's happening? Well, strong momentum down, kind of this corrective pullback, and then strong momentum down again. M1 supply has failed. So essentially this is one big flip, right, from the lower of the reaction to the top of the reaction. You want to refine it a little bit more, well then you have the extreme of the reaction leg, right? So this being the initial reaction leg, arguably a sweep of liquidity. I would view that as a sweep, not the best, right? Typically you want it to be a sweep of a low that caused a high. something like that, right? Anyway, I don't want to get too stuck into that, but essentially we then broke down, and then this high became as inducement for the extreme POI. But this is not, at this point, something I'd want to risk my capital on, because at this point here, you can see how messy this is now, right? The M15, let's see exactly where it was. So yeah, so the M15 was at this point, right? So there's always a possibility, this level is going to hold, etc., etc. There's just nothing going on here on the M15, right? And overall, this just like a correction to go lower. So at this point, that would not be a trade I'd be looking at. But then when it pushes down again, so now you're seeing that sustained bearish order flow, sweep of liquidity, another M1 break of structure, and we had this spike here. That is then this low completely failing, right, in terms of any demand within this wick. So that at that point, then if you are going to kind of take this risky short entry, this one made the most sense out of all of them, because we look at the M1, right? And this is not high probability at all. I'm just saying this is kind of the only way in which you could trade it, and it makes sense to me. Clear intraday order flow is starting to shift bearish, right? You get the fail, you get the sweep of liquidity, you get another break of structure. At this point, that nearest sort of M15 POI had then completely failed, and then this is just basically trying to play the continuation of that order flow. But not high probability in my personal opinion, and something that can just be completely avoided, which is what I did. I'm not willing to risk my capital on that. Then we've come down lower towards that M15 POI. I just was looking just before I hopped on here. It did look like there was, so the M1 chalk up here. I prefer using a solid line for this, to be honest. And then got M1 supply. Right. So price comes into supply, it reacts, pushes down, fails to put in a lower low clearly. So then you can draw your flip once price closes above it from the top of the reaction to the bottom of the reaction. Okay, we only get the flip confirmed when we have this inside bar. When it closes, well, let me just double check that actually. What's the open 78.7, close 79. So that would be closing above, and then we get the chock as well. So once we get the chock, then this is where you can enter on the flip, or of course you can refine it to the single pivot candle if you wish to do so, right? Clearly unmitigated, has a nice inducement with this inside bar. And then that would be your entry. The reason why, for me, I wasn't looking at it, let's see what, 2 pips fits in nicely there. So you could probably enter near the distal. Reason I didn't look at that was simply because we had not mitigated the M15 POI. Also, but the whole M1 entry model is pretty much present except the higher time frame mitigation. So that's why it wouldn't be valid for me. All right, liquidation here, V-shaped reaction, flip, chock, inducement. The only thing it's missing is a sweep. So probably get a few questions about this, but the reason why I wouldn't personally view that flip as a sweep, even though it takes the low of this candle here, is because on the M1 it's not a valid sweep. Why? Because all of these candles break the prior candle's high, then you have the pullback here, and then it continues. Okay, so there's no sweep of a low. What this sweep is here, sweeping this low, is that would be a lower time frame sweep. Okay, so it's up to you whether you have that in your plan. It's obviously better than nothing. It's better than all of the candles just going straight up, but it's not what I would classify as an M1 sweep, okay? But it is some positive confidence, right? Because if you were to jump on the 30 second or the 15 second, that would look like a really nice sweep, okay? But it's not what I personally classify as an M1 sweep, so hopefully that's clear. But yeah, it wouldn't be a valid trade for me because I'll be waiting for this to be hit. Coming into London, I reckon we probably have another dive down. We might reject something within here and then come down into this lows. I would be happy, coming into New York, I'd be happy to look for longs from in here if I was trading it. All else things considered. I'm not in love with this low. I'm not 100% certain I necessarily agree that the M15 is bullish, but based on those mechanical rules, it is. I kind of really just more view this as one big indecisive range. And if you're going to trade from the extremes, then it's always going to have, somewhat of an edge on your side, especially if you're getting in with a 2, 3, 4 pip stop. All you need is a little bit of reaction to remove your risk, right? So if we aren't going to mitigate this POI, I'm going to looking for longs. Ideally now I'd want to see at least that high go, right? See supply start to fail, and then you can start to potentially look from within here, but I would still be cautious that price may want to come in here and mitigate this, or potentially we're literally just going to come into here and then just do that, right, and sell off and continue to the downside. Who knows? That's just the game we play, right? The risks we have to take. So I'll post a markup before New York, but that's pretty much it. I'm not in love with what I'm seeing. In all honesty, I do think the 4 hours more likely to at least move down towards demand, but I still think there could be a decent edge from a POI that swept liquidity, has inducement, in the extremity of this M15 range. So yeah, these are not easy conditions to trade whatsoever. They are gonna, to really test your psychology, especially if you're more experienced. I've barely taken any trades this year compared to last year. There was a lot more cleaner stuff in February, kind of apart from when we were all the way up here. I think that 1 week right at the top, that was where it was very, very tricky. But there's been decent opportunities since. But then obviously with the Ukraine war, it's been tough. It's been very, very volatile, and I think if you're kind of new and then you're trying to jump straight into this, it can knock your confidence. So don't allow it to do that. I think this is where you're just going to have to realize it's not normal conditions, and you're going to have to do your best to try and adapt to those. One of them being figuring out what news rules are going to be for swing structure, whether or not you need to adjust how you size up your entry and your stop loss, right? If you, like me, typically use a fixed 2-pip stop loss, looks like it's working at the moment, right? If this was an entry I wanted to take, that's more than fine with a 2-pip stop loss. But obviously the last few days we've seen that you kind of need nearer a 5-pip SL. But anyways, give me a couple of days to kind of do a bit of testing, and then I'll give you guys kind of a heads up going into the start of next week of how I'm going to approach structure on the 4-hour and M15 going forward. So with that said, I hope you guys have a good rest of the day, and I'll see you in the next one. Cheers, guys.